But I want to take you through quickly what Bill Clinton did to the housing market in this country. Those of you who've lost your homes, those of you who are underwater, those of you who can't sell your homes, the germs of this housing disaster, which has led more broadly to an economic disaster, belong to the keynote speaker. The keynote speaker who's going to tell you how they balanced budgets and created all the surpluses. There was never a balanced budget under Bill Clinton. He'll never mention that Newt Gingrich and the Republicans led a revolution to slow down his spending and to block a lot of his programs. That won't be mentioned either. But Newt's right when he says to the extent we were able to slow down spending, it's the Republicans who deserve the credit because Clinton was full speed ahead. Just he couldn't get it all done. But the housing market has yet to recover. The housing market, for so many people, remains a disaster. It's your biggest investment. It's your biggest asset. And for many of you, it's your biggest disappointment now. How did this happen? Did it happen under Bush? Was it because of free market capitalism? Was it because of the big banks? Was it because of profiteering? How did all of this happen? Well, I wrote about it in Liberty and Tyranny in 2009. I talked about it on the air even before that. So I'm going to give you the facts about this as well. So again, you understand, if you watch the keynote, what in fact is the truth. Just amazing. The irony is lost on the Democrats, I guess, or the hypocrisy is in your face and they don't care. On the stage now, they're bringing on the 12 women U.S. senators who are Democrats. And a couple hours from now, that same stage will have Bill Clinton. I'm sorry, I just find the whole thing preposterous. Meanwhile, the country's gone to hell. What does any of this have to do with anything? Is this some Miss America contest? Seriously, what does any of this have to do with anything? The nation's on the precipice. The people in power right now have put us there. These leftists want to push us over the edge. We don't care if they're wearing pants or they're wearing dresses or they're wearing paper bags over their heads, like some of them should. Now, let's talk about the crisis. Consider the four basic events that led to the housing bust of 2008, which spread to the financial markets and beyond. This is from Liberty and Tyranny, 3.5 years ago. Event 1. In 1977, Congress passed the Community Reinvestment Act, the CRA, to address alleged discrimination by banks in making loans to poor people and minorities in the inner cities. It's called redlining. The act provided that banks have an affirmative obligation to meet the credit needs of the communities in which they are chartered. 1989, Congress amended the Home Mortgage Disclosure Act, requiring banks to collect racial data on mortgage applications. University of Texas economics professor Stan Leibowitz has written the minority mortgage applications were rejected more frequently than other applications, but the overwhelming reason wasn't racial discrimination, but simply that minorities tend to have weaker finances. That's a direct quote from him. Leibowitz also condemns a 1992 study conducted by the Boston Federal Reserve Bank that alleged systematic discrimination. He wrote, that study was tremendously flawed. A colleague and I showed the data it had used contained thousands of egregious typos, such as loans with negative interest rates. Our study found no evidence of discrimination, unquote. But that study from the Boston Fed became the standard on which government policy was based in the Clinton administration. In 1995, the Clinton administration's Treasury Department issued regulations tracking loans by neighborhoods, income groups, and races to rate the performance of banks. The ratings were used by regulators to determine whether the government would approve bank mergers, acquisitions, and even new branches. The regulations also encouraged statist-aligned groups such as the Association of Community Organizations for Reform Now, as you know it, ACORN, and the Neighborhood Assistance Corporation of America, among others, to file petitions with regulators or threaten to slow or to even prevent banks from conducting their business by challenging the extent to which banks were using these loans, to the extent they were issuing them. And with such powerful leverage over banks, some groups were able, in effect, to legally extort banks to make huge pools of money available to these groups, that is, these organizations, money they in turn themselves used to make loans. The banks and community groups issued loans to low-income individuals who often had bad credit or no credit or insufficient income. And these loans, which became known as subprime loans, made available 100% financing. They didn't always require the use of credit scores and were even made without documenting income because the banks had to meet the regulatory quotas set forth by the Clinton administration. So the government insisted that banks, particularly those that wanted to expand, abandon traditional underwriting standards. And they did. One estimate puts the figure of these loans in the trillions of dollars. These were the poison pills. Event 2, in 1992, the Department of Housing and Urban Development, headed by Cuomo, the now governor of New York, who even conservatives tell us, well, he's a fiscal conservative. He's a disaster. HUD pressured 2 government-chartered corporations. You may have heard of them, Fannie Mae and Freddie Mac. HUD pressured them to purchase large bundles of these loans for the conflicting purposes of diversifying the risk and making even more money available to banks to make further risky loans. And, of course, these institutions were headed by Democrats who made tens of millions of dollars on these loans. Congress also passed the Federal Housing Enterprises Financial Safety and Soundness Act, eventually mandating that these companies put 45% of all loans from people of low and moderate incomes, that is, that they make loans, that 45% of their loans go to people of low and moderate incomes. So a secondary market was created for these loans. And in 1995, the Treasury Department established something called the Community Development Financial Institutions Fund, which provided banks with your tax dollars to encourage even more of these loans. So for the Clinton administration, this still wasn't enough. For the Democrats, it still wasn't enough. Top congressional Democrats, including Representative Barney Frank, Senator Chris Dodd, Chuck Schumer, among others, repeatedly ignored warnings of pending disaster, insisting that the warnings were overstated. And they opposed efforts to force Freddie Mac and Fannie Mae to comply with the usual business and oversight practices. And the top execs of these corporations, as I said, most of whom worked for Democratic administrations, including the Clinton administration, especially the Clinton administration, they resisted these reforms while they were actively cooking the books in order to award themselves tens of millions of dollars in bonuses. All of this is backed up with my research in Liberty and Tyranny. Event 3, a byproduct of this government intervention in social engineering, was a financial instrument called the derivative, which turned these subprime mortgages and the subprime mortgage market into a ticking time bomb that would magnify the house bust by orders of magnitude. A derivative is a contract where one party sells the risk associated with a mortgage to another party in exchange for payments to that company based on the value of the mortgage. Some cases, investors who didn't even make the loans, in essence, would bet on whether the loans would be subject to default. So you can see when these defaults started how it resonated throughout the financial markets and throughout the economy. Although imprecise, perhaps derivatives in this context can best be understood as a form of insurance. Derivatives allowed commercial and investment banks, individual companies, private investors to get involved, to further spread and ultimately multiply the risk associated with these mortgages. Certain financial and insurance institutions invested heavily in derivatives, and they were encouraged to do so by the government. One of the biggest, American International Group, or AIG. Event number 4. The Federal Reserve Board's role in the housing boom and bust cannot be overstated. The Pacific Research Institute's Robert Murphy explained that the Federal Reserve slashed interest rates repeatedly starting in January 2001 from 6.5% until they reached a low in June 2003 of 1%. In nominal terms, this was the lowest the target rate had been in the entire data series maintained by the St. Louis Federal Reserve going back to 1982. So they created artificially low interest rates, which, by the way, ladies and gentlemen, we have today as well. When the easy money policy became too inflationary for comfort, the Fed, first under Alan Greenspan and then under its new chairman Ben Bernanke at the end, began a steady process of raising interest rates back up from 1% in June 2004 to 5.25% in June 2006. So the Federal Reserve abandoned its role as steward of monetary policy and used interest rates to artificially and inappropriately manipulate the housing market. It interfered with the normal market conditions and contributed to destabilizing the economy, which is exactly what it's doing today. Then in 2008 and 2009, under Bush, with Obama's support as a senator, and under Obama, the federal government spent tax dollars at a frenzied pace to try and rescue the financial markets from the federal government's own intervention and mismanagement. They came up with the Troubled Asset Relief Program, or TARP. TARP outlays could reach $1 trillion, or 7% of the nation's gross domestic product. It was originally enacted so the government could buy these risky or non-performing loans from financial institutions. But then they changed the mission within weeks. The government began using the funds to buy equity positions in financial institutions, began nationalizing them, presumably, or allegedly, to inject cash directly into these entities. An oversight panel concluded that $350 billion of the TARP funds cannot be adequately accounted for. The Federal Reserve also provided assistance of $30 billion for Bear Stearns, $150 billion for AIG, $200 billion and counting, this was 3.5 years ago, for Fannie Mae and Freddie Mac, $20 billion for Citigroup, $245 billion for the commercial paper market, $550 billion for the money markets. It was poised to lend over $7 trillion to financial institutions, which is slightly over half the size of the entire economy of the United States in 2007. And I could go on, but why should I? It started under Carter, but then Clinton took it and ran with it. The housing market exploded. The financial markets, the banks, investment houses followed. The economy was facing collapse. You're paying for this right now. You're paying for this with this economy. You're paying with this because of what's happening to the price and value of your homes. And we're not even close to being out of the woods. And they don't know what to do. There's a QE3 coming. More money printing. Obama won't stop spending. It's endless. That leads to a complete societal collapse. This is your keynote speaker tonight, Bill Clinton. It wasn't the banks that did this. It wasn't the financial institutions that did this. They had a law enforcement gun, if you will, a regulatory gun at their heads. They were told to do this. They were told by the Justice Department. They were told by the Treasury Department. They were told by Housing and Urban Development. They were told by Congress. They were told by Clinton, you do it or else. And they did it. And now we're all paying the price. That'll be the man spreading more myths about his own legacy as he gives the keynote speech tonight for the Democrats.